The cryptocurrency market is a roller coaster, and recently Bitcoin has been on a downward trajectory. As of March 28, 2025, Bitcoin is trading just below $87,000, a significant drop from its recent high of $88,700. This volatility is nothing new for seasoned crypto traders, but the recent downturn can be partly attributed to former President Trump's re-implementation of tariffs on imported goods. Trump's decision to impose a 25% tariff on imported cars and light trucks has sent shockwaves through global markets. These tariffs, effective April 3, 2025, target major trading partners like Mexico, Canada, Japan, and Germany. This move has injected a heavy dose of uncertainty into the global trade landscape. The ripple effect is being felt across asset classes, including cryptocurrencies like Bitcoin. This isn't the first time Trump's trade policies have rattled the crypto market. In early March, when the initial round of tariffs was announced, Bitcoin experienced a sharp decline, plummeting from $105,000 to $92,000 practically overnight. This sensitivity to geopolitical events highlights Bitcoin's interconnectedness with the broader financial system, despite its decentralized nature. The reintroduction of these tariffs has sparked fears of a potential trade war, reminiscent of Trump's previous term. This uncertainty is leading investors to seek safer havens for their capital, putting downward pressure on risk-on assets like Bitcoin. While Trump's tariffs are creating headwinds, there are glimmers of hope emerging from the regulatory landscape. Under the leadership of Acting Director Mark Uyeda, the SEC has shifted its focus from enforcement to regulatory clarity. This change in approach is a welcome development for the crypto industry, which has long grappled with uncertainty surrounding its legal status. The SEC's newly formed Crypto Task Force is actively working to educate investors and developers about the intricacies of the crypto market. This initiative aims to bridge the knowledge gap and foster a more transparent and informed ecosystem. Furthermore, the recent dismissal of lawsuits against major crypto exchanges like Coinbase, Consensys, and Kraken is a significant win for the industry. These lawsuits, which centered around the classification of cryptocurrencies as securities, had cast a long shadow over the industry. Their resolution removes a major regulatory hurdle and paves the way for wider adoption of cryptocurrencies by mainstream financial institutions. This newfound regulatory clarity is crucial for the long-term health and stability of the crypto market. It provides much-needed certainty for investors and businesses operating in the space, fostering an environment conducive to innovation and growth. The specter of a recession is looming large over the global economy, and the crypto market is not immune to its potential impact. J.P. Morgan, a leading global financial institution, has issued a stark warning, predicting a 40% chance of a recession hitting in 2025. The primary culprit? Trump's protectionist trade policies. The tariffs, according to J.P. Morgan analysts, are disrupting global supply chains and increasing costs for businesses and consumers alike. This in turn is fueling inflation and eroding consumer confidence, creating a perfect storm for an economic downturn. Evidence of this economic anxiety is surfacing in the earnings reports of major retailers like Dollar General and Walmart. Both companies have reported a decline in consumer spending, a worrying sign for an economy heavily reliant on consumer confidence. A recession, should it materialize, would likely have a significant impact on the crypto market. During times of economic uncertainty, investors tend to flee to the safety of traditional safe haven assets, such as gold and government bonds. This flight to safety could result in a decrease in demand for riskier assets like Bitcoin, potentially leading to further price declines. However, it's important to note that Bitcoin has historically shown resilience in the face of economic turmoil. Bitcoin, despite its relatively short lifespan, has already weathered its fair share of economic storms. During the COVID-19 pandemic and the ensuing recession, Bitcoin, along with the broader cryptocurrency market, experienced a significant downturn. The initial shock of the pandemic sent markets into a tailspin, and Bitcoin was not spared. However, what followed surprised many market observers. As governments worldwide unleashed unprecedented fiscal and monetary stimulus measures, Bitcoin staged a remarkable recovery. The influx of liquidity into the financial system found its way into risk assets, and Bitcoin, with its limited supply and growing institutional adoption, emerged as a prime beneficiary. This episode highlighted Bitcoin's potential as both a hedge against inflation and a store of value during times of economic uncertainty. While past performance is not necessarily indicative of future results, Bitcoin's resilience during the COVID-19 recession offers a glimmer of hope for crypto investors bracing for another potential downturn. The current sentiment in the crypto market can best be described as cautiously optimistic. While the recent price correction and the looming threat of a recession have undoubtedly dampened spirits, there are underlying factors suggesting a potential rebound. Institutional interest in Bitcoin remains strong, with companies like GME making headlines for their potential investments in the cryptocurrency. GME's recent $1.3 billion capital raise, earmarked for potential Bitcoin purchases, is a testament to the growing belief in Bitcoin's long-term value proposition. This institutional adoption is a crucial driver of Bitcoin's price appreciation, as it injects much-needed legitimacy and liquidity into the market. Furthermore, data from Glassnode reveals that long-term Bitcoin holders, often seen as a proxy for smart money, are accumulating Bitcoin at its current price levels. This accumulation suggests that seasoned investors view the recent dip as a buying opportunity, signaling their confidence in Bitcoin's long-term growth potential. Demand dynamics are also shifting, with on-chain metrics painting an interesting picture. While short-term traders are taking profits and reducing their exposure, long-term holders are stepping in to accumulate. This dynamic suggests that the recent price correction is driven more by profit-taking than a fundamental shift in sentiment. Technical analysis provides valuable insights into potential price movements and can help investors navigate the volatile crypto market. Currently, Bitcoin is trading within a well-defined range, with key support and resistance levels providing clues about its next move. On the downside, the 200-day simple moving average, currently sitting around $85,500, acts as a strong support level. A break below this level could trigger further selling pressure, potentially pushing Bitcoin towards the next support zone between $82,700 and $81,138, which represents the lows from March 18th. On the upside, Bitcoin faces resistance at the $88,700 to $92,000 zone, where the 50-day and 100-day simple moving averages reside. A decisive break above this resistance could signal a resumption of the uptrend, opening the door for a move towards the psychological $100,000 level. The 20-week exponential moving average, currently hovering around $88,600, also poses a significant hurdle for Bitcoin. A sustained move above this level would be a bullish signal, suggesting that the bulls are back in control. Investing in Bitcoin is not for the faint of heart. Its price volatility can be exhilarating and nerve-wracking in equal measure. However, for those willing to stomach the swings, Bitcoin offers the potential for significant returns. Before diving headfirst into the world of Bitcoin, it's crucial to approach it with a sound investment strategy. First and foremost, never invest more than you can afford to lose. Bitcoin is a highly volatile asset, and its price can fluctuate wildly in short periods. Therefore, it's essential to have a long-term investment horizon and not panic sell during market downturns. Dollar-cost averaging is a popular strategy for mitigating risk in volatile markets like crypto. This approach involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This strategy helps to average out the cost of your investment over time, reducing the impact of volatility on your portfolio. Another crucial aspect of successful Bitcoin investing is conducting thorough research and understanding the underlying technology, its potential use cases, and the risks involved. Don't rely solely on hype or speculation. Instead, base your investment decisions on a well-informed understanding of the asset class. The long-term outlook for Bitcoin remains positive. Its limited supply, growing adoption by institutions, and its potential as a hedge against inflation make it an attractive investment for those seeking to diversify their portfolios. However, it's important to remember that Bitcoin is still a relatively new asset class, and its future price trajectory is uncertain. Therefore, it's crucial to approach Bitcoin investing with a long-term perspective, a clear understanding of the risks involved, and a well-defined investment strategy.